US stocks rip higher on a lower than expected CPI print as bears get squeezed and meme stocks explode higher. Commodities remain heavy on China woes, with the dollar remaining supported on global recession fears. Volatility comes lower across all asset classes as VIX gets below 20, heading into a potentially quiet period into the end of August. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 16th of August, and let's have a look at these markets. Okay, so market action last week. Equities obviously ripping higher on the lower than expected CPI numbers and an emerging Goldilocks narrative, suggesting that inflation can cool amidst a potential soft landing. Whereas that scenario was not really something people were talking about, taking seriously. That's starting to change, right? And so some key analysts, people that I follow, like Darius as well, are starting to give that a much higher probability than it had before, and basically, pay attention to what the market is signaling, and taking that as actually something that has some potential of actually taking place. Commodities gave back their gains over the weekend. Here on the week, the major equities that we're tracking index-wise are S&P, Euro stocks, and China. All up on the week. We've got it 3.5% S&P, just under 1% in the other two. We've also got a sigma move. So just like the vol adjusted dashboard that we had been showing previously, I've incorporated that into my dashboard as well. So we've got the sigma moves up here, and we see that S&P on the week was maybe a 1.5 sigma move for a weekly move. It didn't really do a lot in the other indices from a vol adjusted basis. If we look at commodities, we see that commodities gave back their gains over the weekend after poor Chinese economic data, reigniting demand concerns. So we did have, if you looked at this on Friday, you had most commodities in the green on the week, but, pretty big sell-offs in oil, metals yesterday, kind of giving back all those gains. The dollar eased back after the weaker inflation data, especially against emerging market currencies. But since then, it has bounced on renewed European weakness as people get concerned about where Europe's economy is heading, some issues there. We obviously know about the energy crisis, but now you've got the Rhine water levels creating concerns, stopping resources and goods being transported around the region. That's going to lead to more frictions and more bottlenecks and more problems, basically. And that's what the Euro weakness is starting to maybe price in a little bit more. Yields did back up on the economic optimism, given that we have had, a few beats along the macro sort of data in the US. But then the curves are also re-steepening slightly. They've reached extreme levels, obviously 50 bips negative on 2s10s, bouncing a little bit there. Credit spreads also tightened along with strong equities on better growth data, but they do remain fragile, I believe, to QT accelerating in coming months, because I think that does have quite a strong marginal impact on credit markets. Taking away QE should have probably more impact there. And then lastly, crypto continues to trade well after last week's Ether testnet successfully moved to proof of stake, setting up the main event for middle of September. So that's been, keeping crypto markets well supported. Okay, if we talk about what's kind of coming up this week first, before we move on to sort of some of this macro stuff, we've got obviously some housing data out in the US, industrial production as well. We've got US retail sales on Wednesday, FOMC minutes as well on Wednesday, going to be closely looked at for any clues there. And then really that you got Norway Central Bank rates decision. But outside of that, nothing really to speak of, right? You've got some UK July CPI data, obviously expected to come in quite high, but the UK seems a bit stuck in terms of how much they're going to maybe raise rates going forward. So that's going to could potentially move cable. But outside of that, not too much going on this week. Okay, if we then sort of bring up this kind of next slide, just sort of talking about the S&P really and where it's got to. And yeah, that's the fourth weekly positive return in a row. Okay, and that's the best sort of performance we've had in terms of consecutive weeks of gains since November last year. So that's pretty significant. Obviously, bears have been getting their faces ripped off as non-fundamental buying from the likes of CTAs that we mentioned, vol target, retail, corporate buybacks. That's overwhelming the sellers, basically. Sellers sold too early, and now they're taking some pain, and they're being forced back in. Many hedge funds have been throwing in the towel on shorts, as Goldman points out, as they saw a massive de-risking from their prime flows. S&P posted, like I said, 4 weeks of gains. We had a sea of green on Friday across all sectors, and even the whole of last week, all sectors in the green. And the S&P's kind of bounced up to this sort of getting quite close now to the 61.8 retracement. It's gone through the 50% retracement. And the argument there is that often when it goes beyond that 50% retracement point, then it ends up going back to the highs, basically. It's very rare, or potentially, I'm not sure if it's even done it. If it can get this high, then it then just rolls over again. Meme stocks also catching fire. As you can see from the sort of June lows, the meme stock basket is up, best part of 50%, which is pretty impressive. Okay, retail really starting to chase that again last week. Stocks like GameStop, AMC, Bed Bath & Beyond having some staggering gains. We discussed that in the community call on Friday. Okay, so that's what we're seeing there. Just going a bit more into the kind of positioning and what we've been seeing there. Goldman's again, Prime guys are calling this the largest hedge fund short covering event in the third largest hedge fund short covering event in the last decade. That's what they basically said based on numbers that they look at. You've also got JPM Prime seeing a huge increase in long short net leverage. So effectively people getting stopped back in from not participating in this rally. We saw net leverage, obviously, Z-score with 4-week change. Z-score was basically -3 not long ago. And now it's it's +2, between 2 and 3 on the positive side. So pretty big sort of inflection there. And then if you look at the RSIs across the major US indices, they're all kind of around the overbought area. Russell really out screaming higher as well. But Eurostoxx, Nasdaq's probably the least overbought, but S&P and Russell looking very overbought as well. So quite a different complexion the market has up here than it had a month ago, let's say. But the truth is, CTAs could still be getting long. Could still have room to go if momentum keeps building, right? Because they're not price sensitive. They're price sensitive, but they're not emotional, right? So if the momentum keeps building, they're going to keep buying. Apparently, the estimate is that they've bought around $130 billion in the last month, which is a chunk, right? Vol target also still has buying to do if realized vol continues to come in and markets kind of get stuck around these kind of long gamma zones that people are talking about. That may well induce more vol target buying. Buybacks also in full flow. Charlie McGallagher obviously tracks a lot of this stuff. I got the impression his Macro Voices interview this week that he thinks we're getting pretty close to the end of this in terms of short covering and shorts that need to be covered. But that's just the kind of, feel that I got from his discussion. I think he suspects there is going to be one more leg down at some point as well. Okay. Then if we talk about kind of the soft landing narrative that's emerging, right? So what is a soft landing? Is where we do get inflation come down, but it doesn't come down so hard that growth rolls over in a meaningful way, right? So slow down in growth, but not too dramatic, and inflation comes down as well by itself. That would be the dream scenario. So you look at the kind of makeup of the inflation numbers. Obviously, they missed the headline. Core was still higher, even though less than expected. Month on month of 0.3. But you look here, shelter is still increasing. Food at home is still increasing. There are parts of the data that still show some robustness in terms of inflation. Obviously, we know energy came down dramatically. But, rent of shelter is stubbornly high still, as Macro Alf points out. So it's kind of, I think the jury's still out. I mean, I know Darius's work that he's done over the weekend and his macro scouting report, he's looked at the kind of inflation rate of change. He looks at 3-month SAR seasonally adjusted rate of return on 3 month. And he's also looked at 1 month, I believe. And he's obviously seen that come down a lot. And he's saying if it's coming down at that kind of pace and we get another couple of months of that, that could be dramatic. And we're back down to levels where the Fed can ease off. But I think it's hard to make that call that it's going to come down at quite such a dramatic pace, basically, right? So I think we need to see that. If it does keep coming down at such a dramatic pace, I suspect that's because economic data is rolling over as well. And to that point, you know, the Empire State Manufacturing Survey missed massively yesterday, right? That was a huge miss on a lot of fronts. You know, that they've got various elements to that survey. The employment bit was much worse as well, suggesting that non-farms data is a little bit contradicting that. So it's not clear to me that we're out of the woods yet, and that we're going to get, if inflation does come down at such a fast rate over the next 3 months, I don't think it's just going to happen by itself. I think it's happening because the economy's gone to a pretty sharp standstill, right? And then the last graph to kind of look at from macro graph is this credit impulse, which is kind of the lead that he has on growth, right? I say this G5 credit impulse, inflation and growth will both drop hard. So whilst inflation may continue to decelerate at quite a sharp pace, it's going to struggle to do that without growth doing the same, basically, right? So that's the thing to watch out for. So this soft landing is still potentially a bit of a pipe dream. Remains to be seen that the market is starting to price in. I would kind of call bullshit on that until further notice to actually see that actually materialize. Yeah. Okay. So that's what I'm seeing there. Next chart is kind of talking about financial conditions. We mentioned this as well before, that, you know, the Fed's conundrum here is evident in the chart on financial conditions, right? So if you look back at June, before they hiked 75 bips, and we had this red line, which is the Goldman US Financial Conditions Index. Now, various people have different financial conditions indices that they have different inputs into, but a lot of people look at this Goldman one. But you look at this level, and the idea of raising rates is to tighten financial conditions. And the first rate hike did do that, as you saw the red line jump. But since then, we've had another hike of the same magnitude, and financial conditions have gone all the way back pretty much to where they were in early May, right? And that's because risk assets have screamed higher, right? And a large part, if you look at the contributors to that change in the US Financial Conditions Index, the majority of that contribution, some of it is the dollar, but the majority of that contribution is equities, right? And how much equities have rallied, right? And if you look at rates are moving in the right direction to tighten financial conditions, but equities are loosening them back again, basically. That's basically what the data is looking like, right? So S&P price action, cool wall, shifting higher. So we've been talking about this as the market broke through 4,200. Initially, we didn't see this shifting higher of the options positioning to get that cool wall higher, so it wasn't really bullish. And then once you did get that CPI data and that follow through, it all shifted higher to 4,300, right? So that's basically how it kind of played out throughout the week. Market did consolidate a bit before that CPI number. As you can see, it got itself pretty close to 4,100 again. You know, as Fed speakers came out trying to counteract the dovish rates moves, and non-farm payrolls came out stronger, taking hike probabilities back to 70%. The 70 bip hike in September went back to 70%. But then that lower than expected CPI has taken it back down again, basically, right? So where it's standing right now, I haven't actually checked, but, you know, I think it's somewhere around 50-50. It might have actually gone back towards that higher number because the euro dollar part of the front end of the euro dollar's curve actually did sell back off again. So it may well be getting closer to 75 bips, but the market's still managing to shrug that off. I guess basically the market thinking that that's going to be kind of the last hike potentially, right? And then, you know, obviously markets kind of banged against this sort of 4,300 call wall now, sitting here into Friday OPEX. You would have thought we're going to find some stickiness most likely here, given that the gamma positioning has built up and it definitely is trading like the street is long up here. If we look at, you know, the intraday movement, it is a lot less. So that kind of confirms the idea that dealers are long up here. So I think iron condors might start to make sense into Friday. If you are looking to nick a bit of carry, I haven't really been an advocate of those up till now because I wasn't convinced that the gamma positioning was long enough to actually hold the market. But I think this week, given that we're at Tuesday here, you got the rest of the week, the market, you haven't got a ton of news flow to kind of shock the market away from its current equilibrium. And so you may well find that these type of iron condor structures actually work quite well in this sticky environment. So if you pick your short strikes somewhere around 43, maybe 43.25, that kind of area, there's a fairly decent likelihood the market's going to get stuck around here at least till Friday morning, Friday open, basically. Yeah. Okay. The VIX has collapsed back into the 18 to 20 zone. Okay. And we've got obviously S&P and Eurostoxx curves have gone back into contango. We can kind of show that here. So these are the equity curves, right? So Eurostoxx and S&P are both upward sloping, contango, front end at around 15, 16, back end, and we say back end around 6-month maturities is at around 20. Because China is kind of flat in the high 20s. Okay. So, China obviously a bit of a different kettle of fish. It tends to realize a bit more, but if you look at the carry is enormous because the realize has actually come off in China. So realize is around 17.5 in China, whereas implies are still 27 on. So you've got about 11 points of positive carry selling China gamma. You've got a decent amount of carry selling European gamma, but there's not a lot of carry in selling S&P gamma right now, given that vol's come in so hard in the S&P. We've actually rallied quite strongly. We've kind of been moving all right. So the carry's not there. Now, there is a risk that the market gets pinned and stuck at 4,300, and you might even see that 10-day realized on S&P drop to single digits. That is possible. If that happens, then a bit of carry might present itself again in S&P, which is why I'm saying iron condors make sense in S&P, because the absolute level of vol have actually got pretty low now. The carry's not really there if you look backwards 10 days, right? But if you think there's a bit of positioning that's going to keep the market here, then iron condors are a safer way to play it, right? So if you did something like, I was looking at something like the 42.75, 42.25 put spread, you sold that and you sold the 43.25, 43.50 call spread, you could probably collect around 20 points for that. And on the upside, you're going to lose 25. So you're only going to be down 5 points. And on the downside, you lose 50. So you can make 20 to lose 30. Looks like a reasonable risk reward, given that the market looks like it's going to be supported with all these buyback flows and no major sort of, apart from FOMC minutes this Wednesday, you haven't got that much game-changing news out this week, potentially. Okay. And then the point I wanted to make about skew is that it's in the 0 percentile, right? So here, the 25 delta skew on S&P has flattened pretty dramatically. So all that's happened is the market has rallied, and it's rallied to a point where the curve is much flatter in terms of skew. And that skew, what often happens is that skew naturally reprices steeper, but it hasn't done that because the rally's been so violent and people have actually cared more about owning calls than owning puts. Now, I think if the market starts to cap out here and the long gamma positioning keeps the market here, because vol has got so low, there will be some hedging activity that comes back in, some put demand that comes back in at some point. And I actually think starting to own that skew in S&P does make sense. And the type of trades that you could do to own that skew might be risk reversals. If you want to get short and you haven't already sold the market and you want to hedge yourself, risk reversals, selling calls, buying puts, anywhere in the 1 to 3 month time frame looks decent. If you're not willing to commit too much in terms of selling the market, and you want a more delta neutral trade that takes advantage of that skew, you could sell put ratios where you sell closer to the money puts and you buy multiple downside puts, in the view that if the market does roll over in the next couple of months, vol has got a lot of room to reprice higher, and you're going to kick into some long vol positions, and that could work. And you're carrying those positions about as cheap as they've been in the last year and a half. Basically, that's the idea. Okay. And then I just want to say, like, being the epicenter of where the vol is, it's not surprising to see TLT with the most negative carry. Okay. So if we go back to the kind of dashboard here, you got green carry in the top half of the table, but you got red carry here where dollar yen's moving 4 vols above its implied, but then TLT is moving 7 above its implied. Okay. So that shouldn't be a major surprise given the amount of rates vol that we're seeing and how data dependent the Fed is, et cetera, right? So the reason why, I don't really like TLT vol is that it's pretty much trading at the same as S&P vol. Okay. So you can see here, level of volatility, TLT and SPX are kind of the same, right? And that's actually quite rare, right? If you look back historically, TLT should normally trade at a good sort of 2 or 3 volt discount to S&P. So when it's trading the same level of S&P on a relative basis, it feels expensive, basically. Okay, which is why I prefer the dollar yen vol trade. So I think that's kind of a proxy for US rates. We can get access. You can see the dollar yen vol is down here at 10. So you can get access to the same sort of movement via a much cheaper level of base vol, basically, right? So that's why I quite like that trade. And we can kind of see that quite clearly when you put all the assets on the same map, when you're looking at their implied volatilities and their skews. Obviously, looking at skew, you can see S&P skew here at 4, cheaper than the other 2 equities. Like I said, it's kind of at 0 percentile, looking relatively attractive. You've got USO vol up here, miles above everything else, but obviously it moves more. The skew's quite elevated again, but the skew's quite volatile in oil. The skew seems to be, every time we look like we're breaking down, the skew catches a bid, and then when we bounce, the skew gets offered. So it looks like skew's quite spot sensitive right now in oil. Obviously, copper vol has been coming in, but it's still relatively high, but it is quite a volatile asset. But the skew's relatively relaxed in both gold and copper. As we mentioned in our skew scatter report last week, where we showed that implied levels of skew are quite flat across the metals, but realized skew's been amazing, right? As the market sold off, copper vol exploded, market rallied back, vols got crushed, both in copper and gold and silver. The vols are very spot sensitive, okay? So I think owning skew, again, in the likes of metals, to play a global recession sort of narrative re-emerging, I think that makes sense as well. And I have done that trade. I'll talk a bit more about that in a minute. But I have done that trade in silver to hedge out some of my silver longs, basically. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.